Good afternoon, everybody, and a warm welcome from Cullen Wealth, from myself, Stuart Arnold, Director of Financial Planning and Head of the Cullen Wealth Investment Committee. Also here, for those who haven't met us before, Richard Cullen, our Chief Executive Officer, and Gary Crossley, our Managing Director. We're also very pleased to welcome our friend Justin Onwekuzi from Legal and General Investment Management, and he's here today to do the lion's share of the presenting on the current state of the global economy and the credit crisis, the Russia-Ukraine conflict, etc. I want to thank everyone for joining. I've noticed that we have some new attendees today, as well as some who have attended our recent webinars. A warm welcome to you all. For those that aren't familiar with the process, we hand over to Justin in a minute for him to give his presentation. Those who have submitted some questions, thank you. I will be posing those questions to Justin at the end. We are also recording this today for anybody who may wish to watch it at a later date and even forward it to friends and family. We're always looking for feedback, so please do feedback to me. I think you have my email and my email address. I am personally contactable by everybody, so please do feel to contact me. And indeed, if there's any wider questions at the end that haven't been covered today, do send me an email and I will do my best to get those answered for you. So without further ado, we will hand over to Justin and let him take the reins. Justin. My apologies. It would seem that there's a slight technical error that I'm just dealing with now. Justin, I think you are able now to take over and start presenting.
Ah, yes.
There we go. Thank goodness for that. Over to you.
I need the. I'm driving, yeah.
Yes, you're now the presenter. You should be able to share your screen. If not, I can.
Yeah, because I came off and came back in, so I need to put the slides again. I should be able to do that very quickly. 1 second. So it wasn't just me that couldn't hear you then.
Oh, I see. Could nobody hear me?
I couldn't hear you now, but.
Oh, right. I hope everyone could hear me.
I'll just pull the slides now, so hopefully it's going to work.
So if not, Justin, I can share my screen.
Let me just try. Yeah, I think you might have to, because this is playing up with me.
Okay.
Yeah, is that okay?
Yeah, just bear with me a second. Apologies, everybody. Okay, hopefully.
Perfect. And if you just go into slideshow.
Yeah.
Perfect. That's lovely.
Okay, you let me know when you need me to move on, please.
I will do. There's lots of animations in there, so let's see if we can sync this together. So 8.3, 8.19, they are the headline inflation numbers for the US, the EU, and the UK respectively. Not since the early 80s have we seen inflation numbers of this magnitude. And this presentation, quite cheesily in a way, is called Justin and the Beanstalk. I don't typically like to have my name in presentations that I'm presenting to, but I just say this isn't a fairy tale. The cost of living crisis is real. The inflation giant is real. And it's really important that we have to stop this inflation giant from stamping all over our portfolios. Yeah, it's not all about fear. As I say, my name's Justin Inukasi. I'm the head of retail investments at Legal and General Investment Management, and I'm delighted to speak to you again. We've developed what is an inflation toolkit, which is trying to help investors navigate this inflation giant and protects their portfolios. So we turn the page. There's one.
Sorry, Justin.
Beautiful animation there, and then there's another one. Just in the beanstalk, and then right into it. Perfect. So the big challenge with inflation is that after the global financial crisis in 2008, we saw a number of different initiatives really trying to be put in place in order to generate inflation. The big fear after the 2008 the banking crisis that we saw was that you would see deflation in markets. So we saw an extraordinary amount of stimulus, extraordinary amount of policymakers pushing different inflationary measures into the market to generate inflation. So we click again, just one. So you saw kind of low interest rates, so historically low interest rates. We saw quantitative easing, so this is essentially printing of money. And we saw central bankers trying to target a higher level of inflation, really to try and generate inflation. But we did not see anything. This beanstalk that you see here simply did not grow. One more click. However, perfect. However, since then, we've seen, since 2020, so between 2008 and 2020, we saw pretty much no inflation. Very minimal inflation. And then we saw really three so-called magic beans come along in the pandemic, in this unprecedented both printing of money and giving out money, for governments giving out money during the pandemic. And then more and more in 2022, we've seen this kind of energy crisis really exacerbated by the war we're seeing in Eastern Europe. And each one of these magic beans have generated the greater and greater inflation, and that beanstalk now has started to grow. Stuart, if you... That beanstalk has started to grow. You see the beanstalk has just started to sprout out of the ground. So let's move on to each one of these things. We move on to the next slide. The pandemic first and foremost. The good news is that numbers, even though numbers are still quite high in the UK and in the West, actually what you're seeing is the number of people going into intensive care is actually very low. So you're not seeing anymore that people who are catching the virus are going into ICU, because, you know, majority of the adults in the UK population are now vaccinated. We've got new treatments now. We're better at treating the virus once people get to hospital. So that correlation almost between getting the virus and going to ICU and deaths has really collapsed. And the most vulnerable, really important, the people who are most vulnerable, who are more likely to die from the virus, have mostly been vaccinated. And the graph on the right-hand side, I won't go into huge details there, really just shows that the dark blue line is the one you want to focus on. Look how high that dark blue line was in 2020 and 2021. These are the number of people going into ICU units, and now it's pretty much at that zero level, that when you have the virus, typically people are not going to hospital. But it's not all good news. As Stuart will show you on the next slide, the virus hasn't disappeared, and we are still seeing, particularly in different parts of the world who haven't gone down this vaccination route, that actually locking down, still locking down economies. And we know the impact that locking down economies has on the wider world. China, the second largest economy in the world, is still experimenting with the zero COVID policy. And that means it has a huge impact on the Chinese growth forecasts. And that also has an impact on the rest of the world. So really, really important. Although the UK might be have low ICU admittance. China locking down their economy, by definition, has an impact on the rest of the world as the second largest economy. So the virus hasn't gone away, but on top of that, the virus has caused a lot of supply constraints, and those supply constraints, or those supply, the reduction of supply has caused for prices to increase significantly as the economy has started to reopen. So that's the first magic bean. The pandemic has generated kind of a level of inflation, or started to generate a level of inflation we haven't seen. The second one on the next slide is this. So what this tries to show is the level of income for the UK, the Euro, the four largest countries in the Euro area, and the US. So if you look at the income line, you'd expect over time income grows and grows and grows, household income. So it grows and grows and grows over time. Yeah, very good. But you can see that as you get to 2020, you see a big dip in the Euro and the UK. So this is essentially the pandemic, meaning that gross incomes fell as people were made unemployed, etc., etc. But then government stepped in with the furlough scheme, and you saw this kind of V shape, and the V kind of started to tick back up again, and we start to follow that long-term trend of growing income. The light blue line is particularly interesting because this is the US, and what the US did, they didn't have a traditional furlough scheme the way the UK did based on means testing. What they did, they gave checks to people in the post. So what you saw from the US actually is that income in 2021 ended up being 15% higher than the start of the pandemic, because they were giving cash away to people, whether they were employed or not. So actually, people were incentivized to stay at home, have these checks and spend them. And that's exactly what you saw, or what you've seen. You're seeing a spending boom in the US. And that spending boom has meant that, again, there's been greater demand pushed into goods and services. And that, again, that second beam has generated this greater inflation. So policymakers have had a part to play in generating this inflation since 2020. And the final beam, Stuart, is this. So the war in Eastern Europe is particularly impactful on inflation, because Russia and the Ukraine, to an extent, are huge producers of commodities. So in the news, they talk, we talk a lot about the oil price, which is now over $100. We talk a lot of the gas prices, and the cost of living crisis, having kind of higher gas bills, etc., etc. This is a huge impact on the consumer. But it doesn't end there. It doesn't end with energy. Actually, when you look at mining, when you look at precious metals, when you look at the food that we eat in terms of agriculture, again, you see a very similar kind of outlook, that Russia are huge producers of pretty much every single major commodity globally. And again, if we're embargoing Russia, if we're putting sanctions on Russia, it simply means there are less commodities for us to buy. And what that does, it pushes the price up of commodities, and really right across the world, not only in energy, but in metals, in precious metals, and in the food that we eat, we're seeing increase in prices right across the board. So those three magic beans have led to that beanstalk to start to grow. So Stuart, if you go on the next slide, you'll see that beanstalk hopefully starting to grow. And you see we've got fee, fi, fo, fum, I spill the blood of an Englishman. Well, more of a UK man, actually, if you look at the UK charts here. So what these two charts show, and this is I've got one more chart which is particularly kind of important to get your head around. But what these charts show, the first one shows the sales in the UK. So again, you see this kind of nice kind of blue line, that's the trend line, and then you've got the actual sales, this kind of light blue line around it. You see in 2020 sales collapsed and they bounced back. They collapsed again in the second lockdown in 2021, and they started to kind of now we're at the kind of levels. We're following that trend line, which is again really important. So that's values, and that essentially prices. The chart on the right-hand side shows volumes. So how much, the quantity that people are buying. And what we've seen in 2020, 2021, you expect in the lockdowns that people bought less. But what we're seeing now, again, is that people are starting to buy less. Why? Because the prices overall are starting to increase. So whilst if you look at the total amount that people are still putting in their baskets is the same, the quantity that people are buying is less. So that is a kind of a large impact on the UK economy, and it's just worth noting that as that inflation number gets larger and larger and larger, 9% as I mentioned in the UK, you could only buy effectively 90% or 91% of the basket that you could have bought historically if you spend the same amount of money. And that's fundamentally really, really important, that actually it's not just the quantity that matters, volumes matter as well. So what can you do to stop this inflation giant kind of stamping all over your investments, all over your pensions, all over your savings? Stuart, if you click again. We've developed an inflation toolkit, and the idea of this inflation toolkit is to help investors navigate this inflation dynamic. As I say, you know, there's no point in pulling money out of the market, because you're locking in, if you do that, you're locking in a minus 9% return. Actually, investing makes a lot of sense, and there are certain things you can do in your portfolio to hedge against this inflation risk. So the first one, Stuart, if you move on to the next slide, is think about your bond portfolio. So there may be kind of many people who have invested in the lower risk funds, and you know, in the first 3 months of the year, we've seen the worst return for lower risk funds that we've probably seen in history. And you know, why has that been the case? Well, you've seen the worst performance for bonds in history. So if you look at the kind of flagship bond performance, and you look at the records go back to kind of 1990. You can go even further if you look at other bond performance, and you see that the quarter that we've seen, or the 4 months that we've seen year to date, have been the worst performance of bonds in history. Anytime you've seen bonds perform that poorly, you've always got a bounce back in later months, and actually that's what you've seen in May of this year. You have seen bonds bounce back significantly, but that isn't the most important thing. The important thing is how have other asset classes, when you invest, you don't just invest in bonds, you invest in lots and lots of other things. How have the other things done relative to bonds? And if you go on to the next slide, Stuart, what this bar chart shows, what this bar chart, yeah, no worries. What this bar chart shows is effectively it's upside down. So when what he's saying is, when markets fall, when all of your assets go down, what do bonds do? And typically what bonds do when all of your portfolio goes down is bonds tend to go up in price. Bonds are the defensive part of your portfolio. So these bars, when you see these, I say it's essentially upside down. As markets are falling, bonds, where you see these negative bars, they're providing protection for your portfolio. But what you've seen in 2021 and 2022 is as portfolios, or when portfolios have fallen, bonds haven't given that protection. So really, really important. It's not just what bonds do, it's what other asset classes do relative to bonds. So when you're thinking about kind of a multi-asset portfolio, one of the joys of multi-asset portfolios is that when Some asset classes are doing poorly, some are doing well, and so on and so forth. But what you've seen in 2022, at the start of 2022, in the first 4 months, is that broke down. However, in May, you'll be pleased to hear, in May, this has reversed again, and now you're starting to get protection for your portfolio from your bonds when markets have been really volatile. So really, really important concept here, that those bonds provide protection, and they didn't give protection in the early part of the year, but they're starting to give that protection again. Really, really important to monitor. The second thing to monitor, Stuart, is how much GBP, how much sterling you have, how much pounds you have in your portfolios. And actually, this is really important, not just from an investment perspective, but thinking about your overall wealth. How much of it is in pounds versus overseas currencies? Why is this so important? Because inflation rates are different throughout the world, right? So I've mentioned, for example, in Europe, we're talking about 8.1%. In the UK, inflation is 9%. So, by definition, if you're holding sterling versus euro, sterling is falling by more because of that higher inflation rate. So really, really important. And typically the UK tends to have a higher inflation rate than other developed markets. Why? Because we don't tend to build anything, right? We don't tend to manufacture anything. We tend to, whilst Germany, build cars, and the US have a kind of a huge manufacturing economy, the UK tends not to have that. So therefore, we tend to import a lot of inflation. So one of the things I think is really important in portfolios is to think about how much you have in pounds versus overseas currencies. So if you can go on the next slide, Stuart. I won't go into this in huge amounts of detail, but the line graph on the left-hand side shows two portfolios. One, which is the dark line one, is 100% in pound sterling. The light blue line has an element in overseas currencies. And what this really shows is you can see that in 2016, there was a big spike, a big outperformance of the light blue line over the dark blue line. What happened in 2016? We had Brexit. What happened when Brexit happened? There were fears of higher inflation in the UK versus the rest of the world. And therefore, the portfolio with more overseas currencies significantly outperformed the one without. Really, really important that when there is inflation, really important, UK imports inflation, tends to have a higher inflation rate than the rest of the world. It's important to have those overseas currencies in your overall portfolio in order to maintain your wealth. The last one, Stuart, is to think about both short-term and long-term. We're all long-term investors, but when you see inflation spike up in the short term, there are certain things you can invest in which give you that protection within a multi-asset portfolio. So if you, next one, Stuart. So these are, next one. There's one more. Brilliant. So when it comes to inflation, as I say, there are short-term and long-term things you can do in portfolios. The short-term ones are things like holding commodities. So commodities over the short term, when you have a spike in inflation, tend to do quite well. So if you look if you look at the performance year to date of commodities, they're up in the region of around 35%. They tend to be very volatile, but they do very well in an inflationary environment, and therefore a multi-asset portfolio which has exposure to commodities, as ours do, have enabled some protection versus commodities, versus inflation. Inflation-linked bonds. So this is bonds which have inflation linkage in them. Again, they've done relatively well this year over the short term. But it's not only the short-term inflation dynamic that we need to think about. it's also the long term. What can you do in the long term if inflation remains persistent? And the best thing you can do is invest in companies, so shares or equities, as it says here. Why? Because companies, as inflation goes up, they will pass on the price of goods going up to consumers, and therefore they should maintain some inflation kind of hedging, because they're essentially what they're doing is increasing their prices to consumers as inflation starts to go up. So really important, equities are a really good way of protecting your portfolio longer term. Even though they can be very volatile short term, longer term holding equities can mean you get that relationship to inflation overall. Other things are things like infrastructure, where you think about toll roads, you think about airports, again, things we've got in the portfolios. They tend to have inflation linkage. So as inflation goes up, airports will increase their prices, toll roads will increase their prices, rail companies will increase their prices. So again, infrastructure is a really good way of hedging on thinking about reducing that inflation risk in portfolios overall. So the last thing to say on this is that inflation isn't the only risk. There are lots of other risks out there. So it's really important also, although inflation is a big risk, to think about, okay, how can I manage all these other risks? And it might be, a very personal risk to you, like, having enough school fees for your children, paying for your children to go to university, paying for holidays and so on and so forth. Just preserving your pension. That might be your key objective. So lots of other objectives to think about, not just inflation. It's important to understand the wider risks around that. And this kind of hexagon just shows some of the other risks that are out there. So I suppose in conclusion, 8.3, 8.1 and 9, they are the key headline inflation rates for the US, the EU and the UK. As I say, this isn't a fairy tale. This isn't this is very serious. It kind of eats into your portfolio over time, but hopefully by thinking about the bond portfolio, bonds look like they're back to give protection. Thinking about your currency exposure and thinking about both the long term and the short term, you can navigate this inflation. And this is why this toolkit has been put in place to stop that inflation giant. So Stuart, if you go on to the next one, this is me in a lumberjack shirt. My shoulders are very broad. I've clearly been going to the gym, but you can see I've got an axe. And this inflation toolkit, we think, can chop this beanstalk down to size and stop that inflation giant from stamping all over your portfolios. Stuart, one more. Thank you.
Thank you, Justin. Nice hat. I like the new hat. Very interesting, very engaging as ever. Thank you. I'd like to move on to some questions, if that's okay. And so just running through them. Thank you to the clients for submitting them. So question 1, with the steady but slight increase in interest rates, do you envisage there being a continued rise? And how could this affect the economy and therefore portfolios?
Yeah, so yes, I think there will be a steady rise. I think that central banks have been very clear that inflation is their key, the key thing they're going to address. And it's not just the Bank of England; it's right across the world. We're seeing central banks focus on this inflation dynamic. So then, from a portfolio perspective, the good thing is that we know central banks have been very clear to us that they're going to increase rates. So it's pretty much expected that they're going to do that. So from a pricing perspective in portfolios, much of the rises are already expected in interest rates. So from a portfolio perspective, you've seen the extreme reaction with the bond market in the first 4 months of this year. That was extreme. And when you get these extremes, you tend to find opportunities in markets. So I'm pretty positive overall, actually, that given central banks have telegraphed this very well, and given the market's already reacted, that going forward, actually there are lots of opportunities in portfolios to really add value. The last thing I'd say on this is that interest rates as a tool are probably not as strong as they were in the early 90s, for example, where everybody was on variable rates and so on and so forth. A lot of people are on fixed rates these days. So, even with the telegraphed interest rates, the impact on the overall economy shouldn't be that great overall. And actually what you should see is inflation come down gradually. But you might get to a 10% number before it starts to come down.
Thank you. Next question. How do you feel the short-term future holds, and what could happen if Third World War breaks out?
Well, I think the first thing is thinking about the likelihood of that happening. And we spoke to quite a few experts on this, military experts, but the one we spoke to, which resonated the most to me, we spoke to William Hague, so Lord Hague, and he, clearly has been, a lot closer to the military than I have, and he just said there's no appetite whatsoever to ever engage with Russia directly, and no-fly zones. There's no way that the West and NATO would ever engage in that. So I think the probability of that is very low. And so then you say, okay, if there is a probability of that, what impacts could it have on portfolios? I mean, yeah, I think it depends on how much that escalates, right? So, I mean, yeah, but I suppose overall, if World War III broke out, then you'd expect. I think markets will close, actually, and you saw that during World War II, that market simply just didn't function. So I think that could be a risk, but I think the probability of that is just so low, given the rhetoric that you've seen from the major stakeholders.
Thank you. Next question. When will the market regain confidence?
Full stop. Yeah, so I actually think the market is starting to regain confidence. You're starting to see more positive days, and importantly as well, when you're seeing the positive days, what you're seeing is that the number of companies that are participating, that have positive returns in those days, that are increasing in value, is quite broad, and that broadness and that breadth across the market, I think is really important. Also, I think you tend to get confidence tends to be renewed in markets when you reach huge amounts of negativity. And what you saw last week was, I think you at least for the short term, you've reached peak negativity for markets, and since then you've seen markets bounce back quite significantly, and also you've seen markets functioning the way you'd expect. So you are starting to see now, when shares and companies fall, those bonds that I mentioned, which provide a really important role in portfolios, are starting to provide protection again. So that gives me a lot of comfort that at the very least markets are functioning properly, and we should start to see the returns that we'd expect to see as you go from low risk to high risk.
Thank you, Justin. Next question. Should I have expected my pension fund to have reduced by 10% over the last 6 months based on me being a low risk investor?
Yes. So I think the last 6 months for low risk investors have been, as I say, the most extreme that we've simply ever seen in the history of investing in low risk. And part of that is because, as I've mentioned, that inflation spike has happened really quite quickly. So you've gone from, effectively 0 to 9% in 1.5 years. And that's meant you've had the worst performance of your defensive part of your portfolio that you've ever seen in history. Whenever we've seen huge amounts of negativity for defensive assets, and never to this extreme, we've always had a bounce back, and we're starting to see that bounce back now. And importantly, those defensive assets are starting to provide protection for portfolios again, which is the most important thing. It's not really what they do, it's not really how they perform, it's are they providing protection, and they're starting to provide protection again. So, would you have expected that, or would I have expected that over over a 6-month period? No, but also I wouldn't expect to see the worst performance by far of bond markets in history. So I think it's worth putting into context, and I think it's really important. And unless we think inflation is going to go from 9% to 18%, which I think is very unlikely, then it's very unlikely that over the next 6 months or 12 months, you're going to see the same amount of falls in your low risk funds. And as I say, you're already at the extremes and you're starting to see the bounce back. So hopefully we're talking by the end of the year, much more positive numbers. But the alternative, if you as a defensive investor, is to hold it all in cash and lock in a 9% negative, as I say.
Thank you. As governments and businesses place security of supply lines and geopolitical factors as higher priorities rather than just price and value, are we seeing the reversal of globalisation of a higher manufacturing cost for years to come?
This is really interesting. So we've done a lot of work on this, and actually post the global financial crisis, you started to see globalization start to reverse. If you look at the amount of trade people are doing with each other, you start to see the amount of trade start to reverse, actually driven by China. So China at that time had a policy that, okay, we're going to start to manufacture more ourselves. We're going to start to kind of rely, have a bit more self-reliance. So actually, so you saw this growth in globalization. Then from 2008 to about 2015, it went sideways, and then you saw, Trump get into power. You saw Brexit, and then you start to see this reversal in globalization. One aspect of that, which is really important, it does mean that the level of inflation is likely to be. It's very unlikely that we're going to go back to 0 levels of inflation again in the near term, because of this this almost higher cost of producing goods. There is another side to that argument though, which says actually we've seen less globalization of trade, but actually now I'm sitting here. Look on my laptop. There's people online, etc. There is a kind of a globalization that could occur from that, where essentially companies like Elgin will say, Justin, you're coming into London every day. Actually, we can outsource this job to, I don't know, somebody in Newcastle or even further, and they've got lower housing costs. We can pay them less, etc. So there is an argument to say that actually digitalization and technology actually leads to greater globalisation, but the trend we have seen definitely has been lower globalisation. And I think the war that you're seeing in Eastern Europe has encouraged companies now, countries to think about self-reliance and how they can feed themselves, how they can keep themselves warm, etc., because turning the gas taps off, which the EU has said they want to do at the end of this year, it feels very unlikely that they can actually do that.
Thank you very much. That's the end of the questions. So that's the end of today's presentation. Thank you, Justin. Thank you to everyone for joining us today. As I say, you should each have my email, and if you do need to email me with any feedback, any other questions, anything that you'd like us to present to you in the future, please do come to me, and I'm keen to ensure that you hear from Cullen in a way that you find most informative. So please do come to me, and I'll take all of your ideas and suggestions on board. So for now, I'm going to say bye and thank you very much indeed. Thank you.
Thank you, Justin.
Bye-bye.